Hello and good morning, everyone. Welcome to another episode of the Market Snapshot series. My name is Rufus Kamau, Markets Analyst at FX Pesa. So today, we'll be talking about the key highlight events that are expected to be moving markets today. And these will span quite a number of things, ranging from the Canadian CPI data that we're expecting this afternoon, the interest rate decision by the Reserve Bank of Australia this morning, the interest rate decision by the People's Bank of China this morning. And of course, earlier in the week, we had the Moody's downgrade of the US debt as well as major US banks. So we'll talk about all that and then try to understand the technical analysis, where the charts are lying as of now and where the opportunities may lie. So I can see Paul Carey has already joined and commented. Thank you, Paul. Hello, Jason. I can see Maureen, Romakirari in the house, Ken Moneki. Good morning, and Naomi Wamboy. Thank you guys for joining. Let's get this started. So, first things first, we look at the economic calendar. So from the economic calendar, you can already see what happened this morning. One of them is that China, or the People's Bank of China, decided to cut interest rates. So for the 1 year loan prime rate, they cut by 10 basis points from 3.10% to 3.0% as expected. Then for the 5 year loan prime rate, they cut by 10 basis points from 3.6% down to 3.5%. So this happened at 4 a.m. this morning. Then fast forward to 7:30 a.m., we had the Reserve Bank of Australia interest rate decision, where they decided to cut by 25 basis points from 4.10% to 3.85%. So those are the key developments as of this morning, and we'll try to understand the market reaction to it. So going forward, for the rest of the day, the main highlight news will be the inflation report from Canada. Median CPI year over year is expected to have remained the same in the month of April at 2.9%. Whereas trimmed CPI, which is the main data point that the Bank of Canada observes in making monetary policy decisions, is expected to have remained at 2.8%, same as the previous reading. And of course, if you observe the chart, when the Bank of Canada was cutting rates, inflation was progressing considerably towards the 2% target. So as you can see, the lowest we got here was 2.4%. And since then, there has been a gradual increase. And as per the last reading, we had 2.8, which was a slowdown from 2.9%. So clearly, we should be expecting some reaction to this. And of course, we know that whenever there is a high inflation, the central banks tend to hold rates higher or even consider hiking. And that is usually considered positive for the currency. Then the reverse is true. Apologies for that. So if inflation is moving down towards the central bank target, then the central bank gets the leeway to continue cutting rates. And in that case, it's weakening for the currency. So now that we have seen two central banks cutting rates early this morning, and the overall expectation is that the two currencies continue weakening, that is the Chinese yuan as well as the Australian dollar, then we'll be applying the same kind of reasoning to Canadian CPI. So key focus will be on the trimmed CPI, which is the main data point that the Bank of Canada observes compared to these other measurements from median CPI, common CPI, and core CPI. So outside of that, we should be having more data coming in by tomorrow. So early in the morning, before we get to the next market snapshot, which will be at 11 a.m., we will be getting inflation data from the UK, and this is where we have a big discrepancy between the forecast and the previous reading. So as of the previous reading, the UK inflation was 2.6% in March, and this is annual inflation. And we're expecting a big jump to 3.3%, and such a big jump to 3.3% would likely mean that the pound strengthens. So core CPI is expected to jump from 3.4 to 3.6%, whereas the retail price index is expected to jump from 3.2% all the way up to 4.2%. So the overall reaction is that if we get this data as expected or even higher, then that will be a big red flag about the prices in the UK economy, and that would likely lead to a strengthening of the UK pound. So on the next session, of course, Robert will be covering the news of the day, including crude oil inventories and the speeches by Fed members. And of course, we keep doing this every day, Monday to Friday, covering the main news for the day. So as for other highlights, let's try and take a keen look at them. So just give me a sec. So we have already seen this one. China cuts key rates to aid economy as trade war simmers. So China cut benchmark lending rates for the first time since October on Tuesday, while major state banks lowered deposit rates as authorities work to ease monetary policy to help buffer the economy from the impact of the Sino-US trade war. So Sino-US trade war is another term for China-US trade war. So the widely expected rate cuts are aimed at stimulating consumption and loan growth as the world's #2 economy softens, while still protecting commercial lenders' shrinking profit margins. So on other news, Japan is a main market mover this week, and this is after their prime minister saying that the economy is in a worse situation than Greece. So Greece is not the Greece we know today. It's a Greece that happened about 10 years ago when the economy of Greece was almost collapsing, and they had to take a bailout from Germany and the entire EU in order for them to save their economy. So Japan is also in a such similar situation, and this may explain why their bond yields are rising rapidly, meaning that there is a lot of uncertainty in the Japanese economy. So Japan bonds plunge after weak auction stocks fear of BOJ retreat. So the slump in Japanese bonds worsened Tuesday after the weakest demand at a government debt auction in more than a decade highlighted concern over the central bank's retreat from the market. So the rout sent the 20-year yield surging about 15 basis points to the highest since the year 2000, while the yield on the 30-year bonds jumped to the most that maturity was first sold in 1999. Yields on the 40-year tenor jumped 10 basis points in a sign of nervousness ahead of a sale of that debt next week. So the bid-to-cover ratio on Tuesday's 20-year bond sale, a key gauge of investor appetite, fell to the lowest since August 2012. So what this article is basically saying is that investors are no longer buying Japanese bonds. So in order for Japan to keep attracting investors, then the central bank may have to increase the yield on the bonds, the newly issued bonds. And as a result of that, we are seeing a skyrocketing price in Japanese government bonds, which we remember a few years ago, they were controlled by what we call a yield curve control. So the sell-off is boosting government borrowing costs at a time of growing concern over the country's debt burden, with Japanese Prime Minister Shigeru Ishiba on Monday saying the nation's financial conditions were worse than Greece. I don't want to touch super long bonds, said Ryoma Nagatomo, a senior fund manager at Norinchukin Asset Management, citing simmering fiscal risks and oversupply. So even though foreigners bought record amount of super long Japanese bonds in April, their presence in the market is still small. Japan's life insurers are not filling that gap, as most of the major ones are reducing holdings of domestic bonds. So the Bank of Japan will sound out representatives from banks and securities firms on Tuesday to gauge their views on how aggressively it should proceed with quantitative tightening as yields increased sharply. And when we talk about quantitative tightening, we are basically saying that the Bank of Japan will most likely continue with hiking rates in order to reduce the excess JPY within the Japanese economy. So this has had numerous impacts in the market. So we'll be taking a keen interest on the performance of the Japanese yen this morning. So on other news, this is the Trump side. Hot in Trump's Big Beautiful Tax Bill from MAGA accounts to SALT deductions. So this is quite a lengthy article. It's basically talking about the current bill that has been pushed by Trump to cut taxes, and of course, in some other areas, is increasing taxes. So you might need to dig into this in order to understand the fiscal outlook for the US economy. So President Trump's tax plans have faced a bumpy road in recent days, with Republican leaders aiming for a vote in the House of Representatives before Memorial Day, even as trillion-dollar pieces of the bill remain up in the air. So a significant boost came on Sunday evening when the bill won approval from a key congressional committee, an unexpected victory after it hit a handle at the House budget hearing on Friday. Four conservative Republicans who had joined with Democrats to stall the bill decided to greenlight it while they kept up pressure for changes. So it's all part of a grinding process, with more tax amendments likely to address concerns about the level of state and local tax, also known as SALT reductions. So other pieces of the bill are also under cross review, such as the size and shape of the Medicaid trims being considered. Yet the overall framework of the tax plan is getting clearer by the day, with the package slowly moving forward that will cost trillions of dollars and usher in an array of changes, from how taxes are paid by households to new businesses to new business world provisions. There's even a change to how you might save for your children, with a plan for the so-called MAGA accounts. So clearly, it's something worth checking out later in the day. I believe I can share this link in the comment section, just in case you have some time, you go through it, because there is quite a good number of US sectors that are impacted. And of course, some people will be benefiting, others will be taking a hit. On this other side, Citibank CEO, something deeper is going on in financial markets right now. So it may be JP Morgan's Investor Day today, which brings with it the inevitable Jimmy Dimon CEO successor chatter, but a hard tip to Citigroup CEO Jane Fraser for aiming to snag a few headlines of her own in the rare blog post on Friday. We are entering a new phase of globalization, one less defined by cooperation and more by strategic self-interest, Fraser wrote. So long-held assumptions are being challenged, not just by tariff announcements, but by a deeper confidence shock. The near-term impact is already being felt, and the long-term trajectory is being rewritten in real time. So this is a CEO of a bank that was downgraded last week. Actually, it was yesterday by Moody's. So Citibank, JP Morgan Chase, they have all been downgraded right after the right after Moody's downgraded the US government debt. So speaking of US government debt, let's look at this. Moody's downgrades JP Morgan Chase, Bank of America, and Wells Fargo after the US credit rating cut. So Moody's on Monday downgraded the long-term ratings of top American lenders such as JP Morgan, Bank of America, and Wells Fargo after pushing the US out of the top AAA rating club over its burgeoning $36 trillion debt. It's also downgraded the long-term deposit ratings of Bank of America, JP Morgan Chase, and Wells Fargo to AA2 from AA1. Remember, the ranking moves from AAA down to AA1 and then AA2. So while the US government was taken from AAA to AA1, the banks have moved from AA1 to AA2 and cut the long-term counterparty risk ratings of certain rated subsidiaries and branches of the Bank of New York Mellon and State Street. So a sovereign credit rating cut on Friday sent reports through the global markets and came a day when the US President Trump's tax bill failed to clear a key procedural hurdle as hardline Republicans sought deeper spending cuts. It won approval from a key congressional committee on Sunday in a rare victory for Trump and House Speaker Mike Johnson. The US ratings downgrade indicated that the country has less ability to support the highly rated obligations of these banks, Moody's said in a note. So a lot of these banks have exposure to US debt. So when the US debt is downgraded, then also their books are affected. So they are also downgraded. So looking for that one last update for the day. Just give me a sec. Well, I think we covered it all. So from the Forex highlights, this is the performance as of this morning. So the strongest currency as of this morning, and we have talked about bond yields rallying in Japan, which tends to coincide with the currency. So the Japanese yen has really rallied against other currencies, being up 0.38% against the US dollar. So the Swiss franc is also doing well this morning. Euro, pound, and Canadian dollar slightly up against the USD. Whereas the Reserve Bank of Australia, after cutting interest rates, we have seen the Australian dollar weaken against the USD, being down 0.55% against the US dollar. So as for the week, you'll notice that the Japanese yen is still the strongest currency, gaining by 0.91% against the dollar. The euro and the pound are doing well, up 0.87 and 0.77%. New Zealand dollar 0.75%, Swiss franc 0.61%, whereas the Australian dollar and the Canadian dollar are little moved against the dollar. So for month to date, that is since this month started, the strongest currency has been the UK pound, followed by the Australian dollar and the USD, whereas the weakest one has been the Canadian dollar. So clearly, this is miles apart, and for the short-term movements, it seems like the Japanese yen is the key strength, given that there is an overall expectation of rate hikes. Then on the far end, the weakest currency in the market seems to be the Australian dollar today, right after the Reserve Bank of Australia decided to cut interest rates. So outside of that, if you were to look at other key highlights in the markets, China lowers lending rates for first time since October. So the People's Bank of China slashed key lending rates to new lows in May, in line with consensus and marking the first cut since October. The move follows Beijing's sweeping monetary easing measures to bolster the economy and caution potential fallout from the trade war with the US. So that is a big news in the markets today. Other key highlights include European shares inch higher today. Danish economy shrinks in Q1. Turkey consumer confidence improves in May. Germany producer prices fall the most in 6 months. Australia slashes cash rate to 2-year low of 3.85%, and US futures rise slightly. So on the other hand, on commodities markets, it looks like a mixed picture. With slight movements, only major movers we would say would be natural gas, which is up 1%. We also have wheat, it's up 1.3%. And of course, we have TTF gas, which is up 2.53%. So outside of that, on the indices side, US 500, US 30, and the US 100 or the NASDAQ are all trading lower today, lower than the open. The Nikkei 25 index is also trading lower, whereas European equities are largely in the green, with the UK pound, with the UK FTSE 100 index being up 0.49%. Others have slight gains, such as the German DAX, the French 40, Italian 40s, Spanish 35 IBEX have all been in the green. Australian stock market index 0.48%. Shanghai 0.38% after cutting rates. The Sensex India is not doing really well, down 0.8%. And of course, for Canada, slightly up 0.29%. So clearly, it's a good day for European equities, but for American equities, we can't say the same. So that being said, I believe it's time that we jump straight into some technical analysis and now try to understand what are the key indications in the charts and try to identify potential trading opportunities. So as always, remember, this session does not constitute of any investment advice. It's not a recommendation to trade, so you should always do your own due diligence. So I'm looking at the comment section. What's happening? There is a lot of uncertainty in the dollar index. Explain. So on one side, I would say that there is still a sell America kind of trade going on. And sell America basically means that a lot of investors are concerned that Trump is not done with tariffs yet. Yes, he's doing a lot of negotiations, but nothing has been fruitful so far. Like there's nothing so clear that you can bet on it for the next 1 year. So investors are taking caution, and as a result, that's why we are seeing a drop in the US dollar index. So at the same time, after US inflation dropped to a record low of 2.3%, now investors are heavily confident that the Fed Chair Jerome Powell will be cutting rates on the next meeting, and as a result, that's why we are seeing a weakening dollar. So on the other side, if you look at US Treasuries, the bond yields are really moving up, and this often indicates that we should be expecting to see some weaker dollar in the near future. So Moody's, this is a good question. So Moody's is a company that offers credit rating for financial institutions as well as governments. So it looks at instruments such as bonds, corporate bonds, and entire banking systems, analyzes them, and their analysis is based on risk. So they try to gauge how creditworthy an institution or government is, and then they give that rating. So when they downgrade the US economy, they are telling the world that we are not so confident of the US government repaying its debt. However, they didn't just move from AAA to BBB, so it's just a slight downgrade, though it has never happened before. So this basically tells us that US government bonds are a bit risky, and investors as well as hedge funds will tend to include this in their investing models. Seeing another comment here. So are Trump's policies likely to weaken the dollar in the long run, or what's your take on the USD? Well, so far, from evidence-based analysis, when Trump was leading in the elections, the dollar was pretty strong. When he was inaugurated, the dollar was pretty strong. But since then, every policy, every decision he has made has only but weakened the US dollar. So far, I would say that if he continues in this path, in his political trade war path, it's going to become more expensive for Americans. And as a result, we might tend to see the US economy weakening. So from what we saw with the GDP data from the US in the first quarter of the year, the US economy shrank by 0.3%, which basically indicates that the US economy is weakening and risking a recession, and this is negative for the dollar. So in the long run, I expect that if this period of uncertainty continues, then it's more likely going to continue weakening the dollar. So that's it from that side. Let's do some technical analysis now. So on the technical analysis side, we'll be starting with the dollar index. So clearly the dollar index was on a slight path upwards for about 5 weeks. And now this week, you can see we are clearly testing the lower side of this channel higher. So in this case, more likely that the dollar index may have finished this recovery path and now it's headed back lower. So we should be observing this particular trend line on the lower side, especially on 4 hours. You can also plot it on the 1 hour time frame. And if we happen to see the dollar index breaking below this, then that means that we expect a weak dollar for the rest of the day. So owing to that, and now looking at other currencies, I'll be starting with the one where the central bank made an interest rate cut. So in this case, a 25 basis point rate cut led to the Australian dollar weakening against the US dollar. So yes, we have seen a rebound here. I don't think it was a very strong level for the market to be holding here. So good chance that the market continues in the direction for the day and perhaps retest this level here of 0.63951. So the Australian dollar has been a pretty weak currency for the day. So good chance that it continues weakening, though it was bouncing because the dollar is also pretty weak. So looking at the other majors, the pound made a very strong rally, and this was yesterday. Found a key level resistance. Notice how it coincides perfectly with this area here. Then made a pullback that was retesting last week's high. And after making that pullback, it bounced quite well. So now we should be observing this level here, trying to understand whether the pound will break or not. So if we happen to break yesterday's high, then that would be a key indication that the market is ready to continue this push and get to the next resistance area, which is 1.344. So 1.344 is the next key level for the pound. which was a major resistance some time back on the 29th of April. So good chance that if the dollar remains weak for the day, the pound could extend the gains to that area. So same case for Euro USD, which has been pretty weak after forming a head and shoulder pattern on H4, made a big drop to our target area around 1.10979, and since then has been bouncing off that level and kept pushing higher. So as of this week, we saw a very strong bullish momentum yesterday before erasing some gains in the evening. So today we are already testing yesterday's high, and good chance if we break, then we move on to the upper trend line. The upper trend line connects with a few other points from 28th of April to we're looking at the 6th of May as well as the 7th of May. So clearly the market could retest that, but so far we are already seeing some changes. So from what we are seeing here with the dollar index attempting to bounce from this support area, we're also seeing it in Euro USD attempting to change direction from here. So in this case, if the dollar picks up momentum, then we should be looking at the market retesting the daily low, or rather going all the way back down. So it's still not clear yet, and we're just getting in the first hour of the London session. So let's observe the current candlestick, wait and see until we have a clear-cut direction. So for USDN, clearly you can see that the yen is really strengthening and reversing the strong momentum that we had seen at the beginning of last week. So notice how we started pretty strong, and then the yen recovered quite impressively. And now we are seeing the market pushing yet again, in this case with the yen strengthening further. And of course, a key level is being tested here. And if we have a clean break or a confirmed break towards the lower side, then we expect more bearish momentum. So more bearish momentum would basically mean that the yen strengthens to around 143. This is 143.224 price action level. That would mean some more push lower. So it could play out today or tomorrow, but it seems highly likely. So looking at gold, gold seems to have had some form of inverse head and shoulder again. If you consider this to be the first shoulder, this to be the head, this to be the other shoulder, then we have more of what looks like two necklines. And today we are seeing some momentum coming in. So after seeing the mixed price action yesterday, yes, we know it was a Monday. Yes, the market opened with a gap, attempted to close the gap. Today, attempted to get back to the same gap. And now we are seeing a sequence of greens. These green candlesticks indicating that buyers are coming in strongly. So for the day, it's safe to be looking at a potential move towards yesterday's high, which is around $3,249 per ounce of gold. So strong momentum coming in. So good chance that we assess the market from there. So for Brent oil, it's currently trading in what looks like a bullish channel. So it's still in the mix. So it's a wait and see kind of a reaction. So in this case, we wait until it gets to either of the extremes. That's on the upper side or on the lower side, and then we can make a decision from there. But for now, we are right in the center of the channel. So US30 or the Dow Jones made it to our target, which was the previous high. And now after getting to that area, we are seeing some step back, which likely means that we should be seeing some form of profit taking. So perhaps a retest of previous highs or previous lows. So good chance that we could be seeing the market moving down to 42,482 before making further progress. So it's quite common to see after the market has broken to a new high, make a pullback and then a continuation in the same direction. Long term, it's still very bullish. If you look at the daily time frame, it's still a very bullish market. But then there's always these small pullbacks that last 1 or 2 days and then it continues. So for the Dow Jones, yes, it seems quite bearish today. So long term, it makes more sense to be looking for bullish positions. But for today, it seems like the market is a bit weak and we are seeing some form of pullback playing out. So same thing applies to the Nasdaq 100 index, which is in a what looks like a horn or a loudspeaker. And this is a consolidation pattern. It basically means that the market on average is following this direction. And of course, we have a bias of the bull side because you can see the full cycle market was in a crash, made a very strong recovery, and now it's taking a breather. This is hot. We can say a 5-day breather. It's just not moving up or down. It's just moving sideways. Of course, if we get a pullback, one good idea, if it played out, would be, let's say the market drops to this area, and then you find a nice buy and continue enjoying the direction of the trend. So for the SP 500, we also got to our target. The market rallied higher, got to an even newer high. And of course, it seems like the volatility is slowing down. So if you look at the 1 hour time frame and you look at the price action, yes, yesterday we got into a new high. We had a low. So the lows keep getting higher, the highs keep getting higher. And now I believe we are on a cycle where the market could likely, sorry for that, the market could likely make a pullback and then a jump in the direction of the trend. So if anything, we should be looking for something like this. And of course, on the lower side, you can see this. On the upper side, you can see this. So the value areas tend to be on the lower trend line, not on the upper trend line. So BTC almost made a new high this morning, but now you can see the pullback playing out. So this was a key level here, mainly acting as resistance, and now BTC is retesting this area here. So it could potentially bounce from here and rally, or we see another key drop towards around 102,400, and then a bounce from that area. So this is a more likely scenario, which would present a much better entry compared to the current price action level. So US dollar index we have already covered. New Zealand USD. Here, if you go to the H1, you'd notice that it's quite a noisy market. So from the 4-hour time frame, this is how it looks like. So the New Zealand dollar has been on the losing side compared to the USD. So yes, we have seen all this play out, and now the current swing is towards the upper side. So good chance that we see the market responding positively and extending the rally to this area. In this case, the main resistance point, if you consider this as a dependable trend line where the market has found resistance several times, it has gotten to that area. So as for European equities, if you go to the UK 100, it seems to be the most promising one today, which is threatening to break above this resistance area. So after the big sell-off and 100% recovery, good chance that we break above that area here. So it's one of those markets that you are waiting to see if it breaks. And once it breaks, then good chance it continues in that direction. So we continue observing here to see if there's a break, then squeeze in more bullish positions. The Japanese stock market index, the Nikkei 225 index, clearly has been on a very strong bull run. But now, given what's happening with their bonds, we are seeing the market now taking the opposite direction. So notice how it opened strongly this morning and then later lost some ground, which likely implies that we could still see the market retesting yesterday's low. So this is still a potential play for the day. So on the other hand, for the other European equity indices, beginning with the French stock market index, we are seeing strong bullish momentum from the daily time frame. Notice that we have recovered most of this sell-off, but we are not yet to the previous highs. So recent days have shown mixed reaction. Notice how last week we were up, down, and now this week we are attempting to push higher. So with this kind of price action, it makes more sense to be looking to take advantage of these gaps. So notice how we had a big weekend gap here, and then the market covered the gap completely. And today we have a small gap, and now it seems like the market is pushing to close the gap and get back to yesterday's closing price. So the Spanish stock market index is now hitting a new all-time high, and this is for the whole consecutive day. If you count the candlesticks from the first green candlestick to the current one, we are talking about 9 consecutive sessions where the market has just been hitting new all-time highs. So today is not an exemption. We have just missed the big candlestick, but good chance that there will be more to celebrate. So it's a market that is just making more and more green. So good chance that we continue in that path for the day. So very, very strong momentum in the last hour. Good chance it continues in that direction. So the German stock market index also broke into new all-time highs. So far, we are looking at a streak of 3 consecutive bullish days. And today, there seems to be some form of pullback, but good chance that if the bullish momentum continues, today, we also get an entry. Remember, the best entries are these ones. When the market pulls back, this is when you get some very nice value areas and you enjoy a good run here. So if you apply the same kind of reasoning, then good chance that we have just received another generous pullback where we benefit as the market pushes higher. So for the Euro stocks on the EU 50, if you go to the daily time frame, we have not yet hit 100% recovery. But then you can see yesterday's attempt to move down was met with bulls coming in and pushing prices higher. So good chance we see a continuation today. In this case, likely bullish momentum from here. So lastly, the US dollar trading against the Chinese yuan. Notice how in the early morning trading, the dollar was pretty strong, gain against the yuan. There was a pullback, but then good chance that it continues gaining after the People's Bank of China decided to cut key interest rates and engage in quantitative easing, in this case, further weakening the yuan. So there is a good chance that the market could be headed higher. And of course, there is a key level of interest here. And this is the gap that was left in the market here. So notice how there was a big gap here and the market has not covered that gap yet. So good chance that we see the market coming for this gap. In this case, the dollar gaining against the yuan and extending to the upper side of the gap. So that's it for the day. Thank you very much, everyone. Hello, Simon Carey. Thank you for joining. There's a special request for us to check on Audi Swiss franc. We don't normally cover the crosses because we have covered the Audi USD and USD CHF. Then there's no need to cover the crosses. So the pairs are basically derivatives. So looking at this one, it looks like a market that really made a big move here. And then right after it got here, we got into this slow climb. I would call it a slow climb, where the market kept moving higher and higher along this channel, where it takes much longer to complete the climb than it took to basically meet the sell-off. So the sell-off was swift and within a short period. And then you take what, 4, 5 weeks, 6 weeks climbing the same lane. But then from the 1 hour time frame, you can already see that there's signs of a break here. So if there's signs of a break, as a book pattern, we know that good chance that the market goes to the base of that pattern. But then you have to go step by step. Step 1, step 2 here, then step 3, like that. So you observe the interaction between price from the current price action area to the next support area, and then from there to the next support area, then from there to the next support area. But then you have to do step number 1 before you do step number 2. So now you have a break, good chance that the market now clears Friday's low and then heads straight for this other one. So Friday's low is also still a significant factor in this market. So in this case, very short term push to this area here, 0.53297. And once we clear this area here, then we observe if there's a break. If there's a break, then we start working with this other level here. So for those who are new to this, you should know that we have the Bullish Banter podcast, and we have our latest episode. I'm glad that we are back. We had taken a small break to share some more episodes from our partners in Uganda as well as Tanzania. So in our latest episode, we cover the impact of AI investing. So Kenya Market Insights, Trump 2.0, and navigating to 25 volatility. So in this case, we were joined by Robert Mbogo, our co-host in the Market Snapshot series, and Jesse Ogola, the host of the Bullish Banter podcast. We go deep into some of these market topics, share these insights. If you have some time, make sure to check it out. It's on FX Pesa YouTube. Just go to the channel under podcast, and then you'll find the latest episode. And if you enjoy it, make sure to leave some feedback. So, of course, if you don't have a trading account, check the links in the description below and register for a trading account. It's free, it's online. And once you register, go through our courses, go through our classes. Our links are on our social media channels at FX Pesa. And once you build that skill using that demo account, now go into a live account. So for those who are looking for a course to pay through from a complete novice to pro, then check out the novice to pro course. It's available on FX Pesa YouTube. Once you go through this, then hopefully you will become a better, more informed, more skilled trader and begin making money in the markets. So that's it for the day. Enjoy the rest. And if you are watching this, make sure to leave a like, subscribe, and if you're watching on Twitter, make sure to share and comment if you have any feedback. So that's it. Enjoy the rest of your day.